Well, here's a picture of a cloud. And what do you see? Huh? What do you see? I see a rubber ducky. See, right in the middle. Or is that a guy looking up in the clouds to see what he can see? Well, I think you know where I'm going. Let's try another one. Here are a couple of Jackson Pollock paintings. And do you see something there? Let's try this one. Do you see something there? Maybe it's a Rorschach test. Well, let's spare that and get to the point. Well, here are a bunch of graphs of stock prices. I'm not going to tell you yet whether they're real or not, okay? And Lori and Hamilton, along with a whole bunch of others, said, gee, there's patterns all over the place. Head and shoulders, flag, trend lines, and so on. These are actually randomly created. And I'm going to focus on one aspect that seems to get rid of at least some of the problems about looking for patterns, and that is moving averages. And by the way, they did a study with these people who do look at the charts, sometimes called technical analysts, and they couldn't tell the real ones from random ones. I wonder why. Let's start off with a pretty fair assumption that a price of a security at any moment in time is a function of the available information at that moment in time, noting that it doesn't even have to be accurate or even rational. Could be astrology, somebody's hunch, an outright lie, fake news. I got news for you. That there's been fake news from the beginning of time. A lot of charlatans out there. And let's posit that the price at that next moment, day, whenever, will be a function of information at that same moment, day, whatever, and that the difference between the two, subtracting the prices, would be a function of the new news, the new information at that subsequent time period. And the expected change in price, the expected value of that unknown news, unless you're an insider, and there's laws against that. I wonder why. Maybe it's because, let's not talk about fairness. Instead, if you wanted to play a game where someone had inside information, you'd probably demand that you get a better return, but a better return means less employment, less stuff, not as clean as an ecology, everybody's worse off. So let's just make that illegal. And they can catch you. There's always trails. But in any case, the daily or moment-to-moment expected value of that new information probably would be pretty darn near to zero. But of course, if you take it across time, the expected change in the price probably would be positive if there's a positive trend. Thus, in the literature is something they call the EMH, the Efficient Market Hypothesis. It comes in three flavors: weak, going back in history, semi-strong, looking at current news, and the strong form where they add in the private information. We're going to be focusing on the weak form test, which is just looking back at history, namely charts. And what's the null hypothesis? That some procedure will not get a greater return than some benchmark. What's the alternative hypothesis? That whatever that procedure is, you can beat that return from some benchmark. Some relevant benchmarks include the capital asset pricing model, like-to-like securities. Of course, here's a problem. There's nothing out there that's exactly alike. Is Ford really like GM, really like Toyota, like Mazda, like Tesla? That's a difficult test. Then there's a buy and hold strategy. A lot of people use that, and it's a very good strategy. It says instead of trading, just hold it at the beginning, take it all the way to the end. there's a little bit of a problem. You got to say, well, gee, when do I buy it? When do I sell it? Do I sell it? Well, it turns out it's not that difficult, but it's something to think about. The one I'm going to use, because it's kind of easy, because it's a simulation, is we're going to expect to get 0 because we are using random numbers with an expected 0 mean. Now, there's a difficulty there. Or is it? It turns out that if you're using real stock data, you have only one sample set. You can't test it again and again because there's only one data set. With a simulation, you can test it over and over and over again. That actually is less of a problem. So how do you create realistic but simulated security prices? Well, you take the previous one and you keep the original value in there. There's the 1, and you add a return to it that's, say, normally distributed. I'm going to use 0 mean, so that creates minimal problems. You could add a mean to it if you like, and it comes from a normal distribution with some standard deviation. I used 0.02% daily, and going across a simulated year of 256 roughly trading days, that's the square root of that is 16, and turns out that's a distribution for the standard deviation annually, and in this case that would be 0.32, the 16 times the 0.02, and the normal distribution, well, you could use some of the ones that are available, say, in Excel, but they have some correlation and autocorrelation problems and some distribution problems. So you can actually create it directly using a formula. There it is. The random numbers are uniform. In Excel, you can say rand brackets, or in BASIC, RND, and put a number 1 in there to get a uniform distribution between 0 and 1. And you know what? It creates a very realistic security price distribution. Notice it kind of larger on top. Remember, it's unlimited upward. By the way, the median price does drop, and think about it, that should do that. The mean here is 0. I created it from a 0 mean but uniform distribution, and it's very well behaved. I should pause here to make a observation about something that looks harder than it is, and that is if you're making a moving average, you either create it contemporaneously, so you would trade on it at the very moment or the day, let's say, that it occurred, or maybe you can look at it as a buy or sell signal for the following day. That's no problem. What it is the notation looks a little problematic. You're wondering, why is there always a 1 or minus 1 in there? Let's take a case. You're on day 10, and you want to make a moving average of 3 days. And you're including the 10th, so you want to go 8, 9, 10. Well, let's see. You want to go from 8 to 9 to 10. So you start at 1 plus 10, that's 11, minus the 3, you start on 8. That's correct. And you go through 10. Or if you wanted to do the past one, you would want to go the 7th, the 8th, the 9th day. Well, let's see. You start at 10 minus the 3. That's 7, that's right. And you go through 9. So the notation looks ugly, but is correct. Okay, let's see a result. Here is a run of a single randomly created security across one simulated year using moving averages of, say, 10 and 30 days, and there's a buy signal, and the crossover creates a sell signal. The shorter, more volatile line crosses going to the upside. There's a sell signal. Looks pretty good, doesn't it? And starts to crosses. There's a buy signal, and there comes a sell signal. Now, for the purposes of the graph, some of them may have touched at the edges, but the computer knew what to do. And here comes that sell signal and creates a buy signal. Lo and behold, this thing looks like it should work. But this was a really good-looking case. But one run is not enough. So I did 1,000. Here are two displays. The top one is a frequency distribution of the 1,000 runs with the cumulative total for each year displayed in a frequency distribution of the results. The bottom is a separate independent run with a frequency distribution displayed here of the percentage returns calculated on the base of each buy signal. And you know what the results were? That for the cumulative gains, I had actually minus 0.673, and for the percentage returns, I had a cumulative average of minus 0.103%, and that didn't even include commissions, which would have made it even worse. And no surprise to me, after having done my dissertation, where I looked at every single security for 20 years on a daily basis using trend line charting, a different technique, and again, even as a true believer, I began to understand that maybe those little puffy clouds are just little puffy clouds. And here's where I'd like to add my original contribution. Just about every higher order of, say, primates and a whole bunch of other animals look for patterns around them so they can seek food, shelter, a mate, and avoid danger. And the result of that is they have a bias. And if they over-interpret that data, make a false awareness that's not there, what does it cost them? A little bit of embarrassment, some minor costs, some calories, a couple of cents. You drove across town for nothing. But if you under-interpret, you fail to find the food, the shelter, a mate, and you don't see the danger, well, that can result in severe losses. So you prefer to over-interpret data because the benefit and the cost makes you have that as a preference. But in the stock market, the reverse is true. If you over-interpret the data and trade too often, you suffer commissions. And the other choice is just buy and hold. Well, that's something that's kind of profound. In other words, stop being a nervous Nelly and maybe just let it sit, or at least have a preference to wait a little bit. Another insight from Dr. C Invests.